volatile. We saw this stock run from around $3 to over $12 back in late 2021, when the EV infrastructure hype was at its peak. Since then, it's come back to earth and has been trading in a range between $4 and $6 for the past year. What moves this stock? Contracts. A few months ago, they announced a big new order for their E-block charging solutions, and the stock popped 20% in a day. They are slowly building a backlog of orders, which gives you visibility into their future revenue. It's about execution now. The company has had periods of profitability, but like many companies investing in a new high-growth area, their expenses have been high. They are building out their manufacturing capacity and spending on sales to win these new EV charging contracts. The key here is to watch their gross margins. So, what's the call on PPSI? I like this one. I really do. It's speculative, yes, but it's a tangible business in a booming sector. The demand for EV charging infrastructure is not going away. It's going to grow for the next decade. Pioneer is a small but nimble player that is winning real orders. For an investor who can handle some volatility and is willing to do their homework, I'm calling PPSI a buy. It's a speculative buy, but a buy nonetheless. Let's stay in the energy space and talk about a much bigger and much more controversial name: Sunrun, ticker RUN. This is the biggest residential solar company in America. They install solar panels and battery storage systems on people's homes. Their business model is primarily based on solar leases or power purchase agreements, also called PPAs. This means the homeowner doesn't have to pay the huge upfront cost of the solar system. Instead, they pay Sunrun a fixed monthly rate for the electricity the panels produce, which is often less than what they were paying their utility company. It's a great sales pitch, and it helped Sunrun grow into a giant, but oh, how the mighty have fallen. Sunrun was a market darling a few years ago, with the stock soaring to nearly $100. Today, as of August 2025, it's trading around $14. What happened? A perfect storm. High interest rates are the #1 villain. Sunrun has to borrow a ton of money to pay for all those solar systems they install, and higher rates crush their financing model. Secondly, a policy change in California, their biggest market, reduced the incentives for homeowners to go solar. This combination has slammed the brakes on their growth and thrown their entire business model into question for many investors. The company's financial performance has been a mess to analyze. They have a lot of debt, which is a huge risk in a high interest rate environment. They talk a lot about subscriber value and other complicated metrics, but at the end of the day, the company has struggled to generate consistent positive cash flow. The bears, the people betting against the stock, will tell you that the company's accounting is confusing and that their debt load is a ticking time bomb. The bulls will tell you that the stock is incredibly cheap based on the long-term value of its customer contracts